Mr. Parker, Fundamentals in 10 Minutes. Opendoor went public via SPAC in September 2020. Within 10 months, the share price shot to almost $40 before it dropped to less than $14. Recently, it fluctuates around $20 range. So, is Opendoor a good investment? Established in 2014 and headquartered in San Francisco, Opendoor is a leading digital platform for residential real estate. The company is known as an iBuyer. It makes instant cash offers on properties, makes repairs, and then releases them for sale. It also provides home buying services and financing with Opendoor mobile application. As of the second quarter of 2021, the company operates in 39 cities in US. While traditional home sale is complex and time-consuming, Opendoor has reinvented the real estate transaction. It takes only 3 steps to close their deal. First, home sellers need to answer a few questions about their properties and receive an initial offer. Second, they take a video walkthrough and Opendoor will make a final offer. Lastly, sellers can have the flexibility to schedule a date and close the deal in as fast as 3 days. Opendoor AI-powered platform analyzes the details of the property and compares with recent transactions of similar properties in the same neighborhood. As a pioneer iBuyer, Opendoor has accumulated massive data to give a precise offer that is acceptable for both sellers and the company. In order to reduce the holding cost, Opendoor only takes liquid properties that fall within certain criteria or Opendoor buy box, such as specific town and neighborhood, age of the property, size of lot, price range. This helps reduce hold time to as low as 3 to 4 months. Opendoor has also refreshed the experience for home buyers. Customers can schedule an appointment, unlock the door with the Opendoor app, and take a stress-free tour. The company also provides home mortgage and support buyers with cash-backed offer. Besides property transaction, Opendoor offers bundled services as an extra source of revenue. Investors should understand these services are not provided in-house. Instead, they are sold to third-party suppliers or investors, a very common practice in the industry. Title and escrow are so far the most accepted service. We'll see how the other services perform in coming quarters. As of Q2 2021, adjacent services take only a small percentage of revenue. The vast majority of revenues are still generated by home sales. The company targets customers looking for convenience and certainty. The vertically integrated services have greatly accelerated the transaction process. Customers are happy with their experience at Opendoor. Now let's talk about market opportunity. There are 1.3 trillion worth of properties sold annually that fall within the Opendoor buy box. The company expects to eventually take 4% of the total addressable market. That brings in an annual revenue of $50 billion, 25 times of its annual revenue today. Although iBuyer is a disruptive business, there are already several players in the field, with Opendoor at the first place, followed by Zillow and Offerpad. They are fighting fiercely in each market for properties. The competition reminds me of the Monopoly game. Opendoor as the first mover gets a lot of advantage by piling up inventory and having more market data. This helps deliver competitive and accurate home valuations and predict a market trend. Zillow, however, is catching up at fast pace thanks to its existing customer base in traditional real estate market. At this stage, all the iBuyer companies are cash burners, as they have to expand the business by acquiring more properties in each market. Here is a chart showing the growth of listed inventories for each company. This aggressive expansion is leveraged by taking more loans at an average interest rate of 3%. Investors should be aware that we are currently in a heated real estate market and low interest environment. This chart shows how many days properties are sold after listed on the market. This chart shows the federal interest rate. We are currently at history low for both numbers. If liquidity starts to dry out and market changes direction, the company may find itself in financial trouble. Opendoor believes the properties that they purchase are the most demanded and stable in valuation, therefore has the minimum risk. In case a real estate downturn does happen, the company could rent the properties to offset the holding cost. Now let's look at the financials. Q2 2021 earnings release looks fantastic. Compared with the last quarter, revenue went up by 59%, gross profit grew by 64%. The company is very confident about their revenue guidance of 1.8 to 1.9 billion for the next quarter. However, the net income is still negative at 144 million. It is still unprofitable at this stage. OpenDoor highlights the contribution margin of 10.8% to show their increasing unit economy. Contribution margin, which accounts for only the direct selling and holding costs, does not consider all the other non-direct expenses, such as non-direct sales and marketing, general and administrative, technology and development. The logic behind this, these expenses are regarded as fixed costs and are expected to reduce considerably as a percentage of revenue. It applies especially to manufacturing industry, where the production growth within a certain capacity does not significantly increase the fixed costs, such as equipment, staff salary, etc. But in the case of OpenDoor, the situation may not be the same. Here is a chart of SBC adjusted operating expenses as a percentage of revenue for Q1 and Q2 2020 and 2021. There are the only 4 quarters with 10Q reporting available on OpenDoor Investor Relations. We could see the operating expenses keep increasing as the company expands to new markets. The only exception was Q2 2020, when the company laid off 35% of its employees after pandemic lockdown. These expenses have to drop to 11% only to make even, which is quite unlikely during fast expansion. We are now looking at the revenue for the last 8 quarters. The trailing 12 months revenue is 4.5 billion for Q2 2020 and 2.5 billion for Q2 2021. That makes a 44% shrink in revenue. The share outstanding is 85 million for Q2 2020 and 588 million for Q2 2021. That marks almost 700% dilution. The price at the end of Q2 2020 was $11 per share. It should be $1.60 per share on dilution adjusted basis. The price today is $20.35 per share. That is 1,300% appreciation. Let's say in another way, you bought a whole pizza last year for $11 and this year the pizza is 44% smaller, but you have to pay $20.35 just to get a slice. This is basically how I feel, period. If we compare with the other players in the field, Zillow has a positive operating margin, PE ratio, and a better quarterly revenue growth. With its existing customer base and business integration, it is more likely for Zillow to reduce fixed costs to achieve profitability in iBuyer sector. As they are playing in a highly capital-intensive and cash-thirsty field, Zillow is clearly better positioned with its current ratio. We are now looking at the balance sheet of the two companies. You could see OpenDoor is highly leveraged to expand its business. In the face of market correction or economic downturn, companies with liquidity risk will be the first one to be dumped, even if its fundamentals may not have changed.